I mean, you can't build a house out of Bitcoin. Even if you made a bunch of money on Bitcoin and can now buy a house with Bitcoin, the house is still made out of wood and brick and copper and all the other things that physically go into it. And I'll go further and say, of course, gold still matters. Gold is still money. Even the international banking system recognizes gold as a tier 1 asset under Basel III. So no, you're not crazy, dear audience. Yes, you're right about your core beliefs. But let me push back a little bit, not to steel man the other side, because that's not me. But let's look at, if reality matters, then we need to look at what reality has been telling us over the last couple of years. So if nothing else, the reality is that if you just sat on your hoard of gold like Smog the Dragon and didn't look at anything else, you did miss a lot of opportunities, some spectacular ones. If you had bullion only, actually the better gold stocks did better than bullion last year. But let's set that aside. If you stuck with gold and gold stocks or silver and silver stocks, obviously Nvidia did better last year. And my joke about over the weekend is, if you had been the first person to buy the new Trump coin, I don't know, it could have been 100x within an hour or two. I don't know how crazy that went, but I'm not recommending that anybody diversify or buy any of these other things. I'm just pointing out that this is a fact, that anybody that jumped on some of these things early could have made a lot of money. Some people did. Some people got left holding the bag. But there is an opportunity there. And I'm not just being intellectual here and trying to make a counter argument. I'm saying this is the world we're in. And I think we as realists, if we think we're realists, we need to pay attention to that. And let me give you one more takeaway from this. If you look at the lesson of 2024, as a gold butt, right, as a metals and mining kind of hard rock guy, I'm looking at 2024, and we had, at least nominally, all-time high after all-time high, and gold going up, and it was like 8 all-time peak, one peak's going.
That's just against the US dollar. It's been hitting those for years.
All around the world. Yeah. In the futures market, we got to 2,800, and you would think the conventional wisdom is in our little corner of the market. The conventional wisdom is, oh yeah, when the rising tide will lift all ships. Come the mania phase, all these stocks will go crazy. But guess what? I mean, if $2,800 gold couldn't float all the gold stocks, you got to ask yourself, what will? Now, some people are saying, you're asking, does gold matter anymore? I think we all know, and the audience knows, yes, it does. But there's a harder question to ask is, are the gold stocks still a good speculation? And if you look at the GDX, right, the big gold ETF of gold stocks, it moved about the same as gold in 2024, give or take 1% or 2%, right? What's the point? Why would you take the risk of buying these, as Doug Casey used to call them, these crappy choo-choo train industry mining stocks, 19th century stuff? Why would you buy that if you're not getting any leverage to the metal? If you're only going to make as much money as gold itself, why take that risk? I think this is a serious question that, gold enthusiasts and silver, really any other commodity, but particularly monetary metals enthusiasts, should think about. And my answer here is, don't give up. Don't throw out the baby with the bathwater. The message of 2024 is not that gold stocks are dead. If you look, like we talked about the GDX, and I'm almost done here.
I'm enjoying this discussion.
Okay, so we look at the lesson. Like the GDX, just barely kept up with gold, but in there we had some majors that had serious trouble. Political risk, mine confiscations, 240 tons of gold confiscated. You know who I'm talking about, right? And we had others disappoint, and then we had the more quality operations really deliver in spades. And those guys, they're sitting at 52-week, if not multi-year highs. So here's the takeaway. Here's the lesson. The data, the reality, never mind our ideology. The lesson of 2024 is that we had a stock picker's market. It was not a rising tide lifts all ships, even with gold going from 2,000 to 2,800. Maybe 3,000, a nice big round number like that this year. I think that's easily doable. Maybe that will get the excitement going. But the most recent data we have from 2024 says, don't assume that. That doesn't mean give up. It does mean you need to be a stock picker. You need to focus on quality. You need to focus on the people that are actually delivering the goods. And that covers exploration and development as well as production. Where do you want to go from there, Duncan? So the industry convention is that the 3-year trailing average is a reasonable price assumption for monetary metals, for gold and silver. And remember, these have such concentrated value that your payback on a mine, a good mine should be 2 years, no more, 3 maybe. So using a 3-year trailing average, if your project works and works well with that 3-year trailing average and your payback is within 2 to 3 years, that makes sense. There's a logic for that, why we choose these numbers. Now, in a rising environment, I don't like to call it the gold price. I call it the gold dollar exchange rate because gold is money and I see it as a Forex question. But anyway, if we're in a rising environment, then a 3-year trailing average, you're averaging in lower prices. So that's very conservative. But really, since the spike in 2020, before 2024, gold was kind of sideways for those years with volatility. So if a year ago, in January of 24, before the latest hockey stick, you used a 3-year trailing price, it would actually be pretty close to spot. That wouldn't really be very conservative. You hear what I'm saying?
Yes. Mm-hmm. Yeah.
You're not building in those lower prices into your average. The worst, of course, scenario is we haven't seen this for a while, but I kid you not, I remember this. When gold is declining and you use the 3-year trailing average, you get an average price that's way above current spot, and that obviously is a ludicrous thing to use. Any serious operator will discount spot. They're not going to give you a price that you can't actually get on the market today. And if you see a feasibility study that has something like that above market, not just gold in any metal, like these, lithium or nickel or some of these others that have fluctuated so much, beware of this thing. Beware of a price assumption that's not real today. That's the bare, minimum requirement. So, right now we're in a rising price environment again. So that 3-year average is looking conservative again. But it's been 1 year. We just had a hockey stick. Would a correction be possible? I just mentioned that we could hit 3,000. I don't think that's that far out there. But we also saw gold wobble when Trump won.
Yes.
And the wrong outcomes here. As long as the world thinks that if the Fed's going to hike rates, that's going to be bad for gold. The wrong news could actually send gold down into correction mode again. So if you're looking at an assumption that looked conservative 6 months ago, it may not be 6 months from now. All of which is to say, this it's not rocket science, it's just rock science, right? Just look at that assumption and make sure that your price assumption is reasonable. And one more quick thing, I didn't mean to go down due diligence university here, but that gold price assumption or copper or whatever it is, it's very important. The other things, the metallurgical recovery rates, these are all set by engineering studies. So unless they're lying, they're probably right. But there is another big assumption that you just arbitrarily set, and that's the discount rate. If you say, the industry, typically in mining, they'll use a 5% discount rate on that net present value calculation. And it's what everybody does, so I hold my nose. But really, mining is so risky that's the minimum. And if you've got a project in, Ebola Central, then 8 or 10% would be a better discount rate. So watch out for that discount rate. If you've got a project and it's in a risky area, there's political risk, safety risk, medical risk, currency risk, whatever, then that 5% is probably not a reasonable discount rate. So, and a lot of people don't pay attention to that. So watch for that one to sneak up on you. It'll give you a number that's better than it deserves to be.